The headlines are alarming, inflation is surging, recession fears are mounting, and global economic growth is slowing. For many, these terms feel abstract numbers on a screen, far removed from daily life. But the truth is, these forces impact everything. The cost of groceries, fuel, rent, your investments, and even job security. Ignoring them can be costly, but understanding them can provide a roadmap to protect your wealth and make strategic financial decisions. Inflation silently erodes purchasing power, making every dollar worth less over time. Recessions threaten jobs, spending, and corporate profits, creating waves of uncertainty that ripple through markets. Meanwhile, the global economy is more interconnected than ever, meaning a crisis in one country can trigger consequences worldwide. Central banks and governments constantly adjust policies in an attempt to stabilize these forces, but their decisions can create additional risks or opportunities. This video breaks down inflation, recession, and the global economy into 7 critical points, showing how these forces operate, how they affect your finances, and what steps you can take to protect your wealth. Understanding these economic dynamics isn't just smart, it's essential in today's unpredictable world. Let's watch. 1. Understanding inflation. Inflation is the rate at which the general price level of goods and services rises over time, gradually eroding the purchasing power of money. When inflation accelerates, a dollar today buys less than it did yesterday, which can impact savings, investments, and living standards. While moderate inflation is a natural byproduct of a growing economy, periods of high inflation, sometimes referred to as hyperinflation in extreme cases, can create widespread economic pain. Over the past few years, global economies have seen inflation rise due to a combination of factors, including pandemic-related stimulus measures, supply chain disruptions, rising energy prices, and shifts in consumer demand. These conditions have translated into higher prices for essentials such as food, energy, and housing, affecting household budgets and consumer confidence. Governments and central banks actively monitor inflation, adjusting monetary policy by raising interest rates to slow borrowing and spending. For individuals, understanding inflation is crucial because it informs decisions about spending, saving, and investing, ensuring that wealth is preserved over time despite rising costs. 2. The nature of recession. A recession is generally defined as a period of sustained economic decline, often measured as 2 consecutive quarters of negative gross domestic product (GDP) growth. During recessions, unemployment tends to rise, business activity slows, consumer confidence drops, and investment often contracts. The fear of recession can drive market volatility, leading to sharp declines in stock prices, currency fluctuations, and higher borrowing costs. However, recessions are not anomalies, they are a natural part of economic cycles. Understanding the signs of a potential recession, slowing GDP growth, declining industrial production, and reduced consumer spending can help individuals and businesses take proactive steps to mitigate risk. Those prepared with an emergency fund, minimal high-interest debt, and disciplined spending plans are better positioned to weather the storm. For investors, recessions can also create opportunities to acquire undervalued assets, as market sentiment often overreacts to negative news. Recognizing the cyclical nature of economies allows people to make decisions based on data and strategy rather than fear. 3. The interconnected global economy. The global economy is a vast, interconnected system where events in one region can have cascading effects worldwide. Trade flows, investment capital, energy markets, and supply chains link countries in complex ways. A slowdown in major economies, such as China, the European Union, or the United States, can impact exports, corporate profits, and employment around the globe. Similarly, geopolitical events, such as conflicts, sanctions, or trade disputes, can disrupt global markets, commodity prices, and currency values. The COVID-19 pandemic highlighted these interconnections, demonstrating how supply chain bottlenecks in one region created shortages and price spikes internationally. For investors and businesses, understanding the global economy provides insight into both risks and opportunities. International diversification in investments, awareness of foreign market trends, and attention to macroeconomic indicators can help mitigate risk and optimize returns. Those who fail to recognize global interdependence may be blindsided by events that seem unrelated but have far-reaching consequences for their finances. 4. Monetary policy and its impact. Monetary policy: the actions of central banks to influence money supply, interest rates, and credit availability play a decisive role in shaping economic conditions. Central banks, such as the Federal Reserve in the United States or the European Central Bank, adjust policy to balance inflation, employment, and growth. During periods of high inflation, central banks may raise interest rates to reduce borrowing and slow spending, cooling the economy. Conversely, during recessions, they may lower rates, purchase government securities, or inject liquidity to stimulate demand. These decisions directly affect mortgages, loans, bond yields, and stock valuations, impacting both businesses and households. For individuals, understanding monetary policy is critical for anticipating changes in borrowing costs, investment performance, and the general economic environment. Policy shifts may take months to fully influence the economy, requiring patience and strategic planning to navigate their effects successfully. In essence, monetary policy is a primary lever controlling the ebb and flow of economic activity and personal finances alike. 5. Fiscal policy and economic stabilization. In addition to monetary policy, government spending and taxation, collectively known as fiscal policy, have a profound influence on the economy. Fiscal measures include government investments in infrastructure, stimulus programs, social services, and tax policies. During slowdowns, governments often increase spending or offer tax relief to encourage consumption and investment. For example, a stimulus package can temporarily boost disposable income, encouraging spending and stabilizing markets, while tax hikes can reduce corporate profits and personal wealth. Awareness of fiscal policy allows individuals to plan for changes in taxes, social programs, and public services, while understanding how these measures interact with inflation and recessions helps navigate both challenges and opportunities. 6. Protecting wealth. During inflation and recession, periods of high inflation and economic downturns pose significant risks to savings, investments, and purchasing power. Protecting wealth requires strategic planning and diversification. Historically, certain assets have demonstrated resilience during turbulent economic periods. Equities in companies with strong fundamentals and pricing power tend to maintain value as they can pass costs to consumers. Inflation-linked securities, such as Treasury inflation, protected securities TIPS, provide additional protection by adjusting principal value based on inflation rates. Diversifying across asset classes, geographic regions, and industries reduces vulnerability to shocks, while careful risk management ensures that downturns do not derail long-term financial goals. Understanding the relationship between economic cycles and asset performance allows individuals to make informed decisions that safeguard and grow wealth over time. 7. Strategic planning in an uncertain economy. Navigating economic uncertainty requires discipline, foresight, and flexibility. Maintaining liquidity through emergency funds, managing debt prudently, and diversifying income streams are essential steps for financial resilience. Ongoing education and awareness of economic indicators empower individuals to make proactive decisions instead of reacting to fear-driven headlines. Strategic planning transforms uncertainty into opportunity, allowing households and investors to protect assets, capitalize on undervalued opportunities, and maintain confidence in volatile markets. Rather than succumbing to fear or speculation, those who approach inflation, recession, and global economic challenges systematically can achieve stability, resilience, and sustainable growth over the long term. Understanding and anticipating economic trends is the foundation for both personal and professional financial security. Conclusion: navigating the forces that shape our economy, inflation, recession, and global economic dynamics are not abstract concepts. They affect every financial decision, from daily spending to long-term investments. Let us know in the comments what you think about the inflation, recession, and global economy. And don't forget to like, subscribe, and stay tuned for more captivating content on our YouTube channel.